Benjamin Graham's The Intelligent Investor is a cornerstone of financial wisdom. Published in 1949, it has stood the test of time, guiding countless investors through the complexities of the stock market. It introduces the powerful concept of value investing, a strategy that has been embraced by some of the most successful investors in history, including Warren Buffett. Value investing is simple. Buy stocks when they are undervalued. This means purchasing shares of companies that are trading for less than their intrinsic value. Think of it like buying a dollar for 50 cents. The idea is to find bargains in the market where the price of a stock does not reflect its true worth. This strategy focuses on the intrinsic worth of a company, not short-term market fluctuations. Intrinsic value is determined by analyzing a company's fundamentals, such as its earnings, dividends, and growth potential. Value investors seek out companies with strong fundamentals, regardless of temporary market trends. They look beyond the daily ups and downs of the stock market to find companies that are fundamentally sound. They look for businesses with solid earnings, strong assets, and competent management. These are the hallmarks of a company that is likely to perform well over the long term. This approach requires patience and discipline. Value investing is not about making quick profits. It's about building wealth steadily over time. It's about ignoring the noise and focusing on long-term value. By staying the course and not getting swayed by market volatility, value investors can achieve significant returns in the long run. Value investing is more than just a strategy. It's a philosophy. It's a mindset that requires patience, discipline, and a deep understanding of the market. Unlike other investment strategies that focus on short-term gains, value investing is about finding undervalued stocks and holding on to them until their true worth is recognized by the market. It's about being a business owner, not a stock speculator. When you invest in a company, you are essentially becoming a part owner of that business. This means you should care about the company's long-term success and not just its short-term stock price movements. When you buy a stock, you are buying a piece of that company. You should think like an owner and consider whether you would want to own the entire business at its current price. This perspective helps you make more informed and rational investment decisions. Therefore, you should understand its business, its industry, and its competitive landscape. This involves thorough research and analysis. You need to look at the company's financial statements, understand its business model, and evaluate its competitors. Only then can you determine if the stock is truly undervalued. This approach emphasizes a long-term perspective. Value investing is not about making quick profits. It's about building wealth over time. Just like a plant takes time to grow, so does a good investment. Patience is key. The market may undervalue a great company in the short term. Market fluctuations and investor sentiment can cause stock prices to dip below their intrinsic value. This is where value investors see opportunity. However, over time, the true value tends to emerge. As the company continues to perform well, the market eventually recognizes its true worth, and the stock price adjusts accordingly. This is the reward for the patient investor. Value investors are willing to wait for this recognition. They understand that investing is a marathon, not a sprint. They are not swayed by short-term market volatility and remain focused on the long-term potential of their investments. They understand that the market is not always efficient. Prices can be influenced by emotions, news, and other external factors. By staying informed and maintaining a disciplined approach, value investors can capitalize on these inefficiencies and achieve superior returns over time. Short-term market fluctuations are like noise, distracting you from the bigger picture. Value investing is about tuning out this noise and focusing on the long-term growth of your investments. It's about ignoring the daily ups and downs of the stock market. Imagine a sturdy oak tree. The wind may blow and the branches may sway, but the tree remains rooted and strong. Similarly, a well-chosen portfolio built on value investing principles can weather market storms. Patience is key. Fundamental analysis is the bedrock of value investing. It involves diving deep into a company's financial statements. This includes examining its income statement, balance sheet, and cash flow statement. The goal is to understand the company's true earning power and financial health. Look for companies with consistent profitability, low debt levels, and strong cash flow. These factors indicate a healthy and sustainable business. Remember, you are not just buying a stock. You are becoming a part owner of the company. Choose wisely. Section 5, the margin of safety, your investment cushion. This concept is a cornerstone of value investing, a strategy that has stood the test of time. One of Graham's most important concepts is the margin of safety. It's a principle that can protect you from the unpredictable nature of the stock market. This means buying a stock at a significant discount to its intrinsic value. By doing so, you create a buffer that can absorb potential errors in your analysis. It's like having a safety net for your investment. Just as a tightrope walker feels more secure with a net below, an investor feels more secure with a margin of safety. If your analysis is wrong, the margin of safety helps cushion potential losses. This buffer can be the difference between a minor setback and a significant financial loss. Think of it like buying a car. You wouldn't pay the sticker price without negotiating, right? You want to ensure you're getting the best deal possible. You wouldn't pay the sticker price without negotiating. You'd want to know the car's true value and aim to pay less than that. Similarly, value investors look for bargains in the stock market. They seek out stocks that are trading for less than their intrinsic value, providing a margin of safety. They want to buy companies for less than they are worth. This approach not only aims for potential gains, but also minimizes the risk of loss, making it a prudent strategy for long-term investment success. Section 6. Mr. Market, friend or foe. Graham introduces the concept of Mr. Market. Imagine Mr. Market as an emotional fellow who offers to buy or sell you stocks every day. Sometimes his prices are rational, other times they are driven by fear and greed. The intelligent investor understands this. Don't let Mr. Market dictate your investment decisions. Instead, use his irrationality to your advantage. Buy from him when he's fearful and sell to him when he's greedy. Remember, you are in control, not the market. Section 7. Actionable tips for new value investors. Start by investing in what you know. If you understand a particular industry or business, it's easier to analyze its potential. Read financial statements carefully, but don't get bogged down in complexity. Focus on the key metrics: earnings, debt, and cash flow. Be patient. Value investing is a marathon, not a sprint. Don't expect to get rich quickly. Focus on finding undervalued companies and holding them for the long term. Remember, time is the friend of the value investor. Section 8. The benefits of value investing. Value investing offers several benefits. First, it provides a margin of safety. By buying assets for less than they are worth, you reduce your risk. Second, it emphasizes fundamental analysis, which helps you make informed investment decisions. Third, value investing promotes patience and discipline. It encourages you to ignore market noise and focus on the long term. This approach can lead to more consistent and potentially higher returns over time. Section 9, conclusion, embrace patience and research. Value investing, as championed by Benjamin Graham, is a powerful approach to building wealth. It requires patience, discipline, and a willingness to learn. Embrace the principles of fundamental analysis, margin of safety, and a long-term perspective. Remember, investing is not about timing the market, it's about time in the market. The more you learn and the longer you invest, the better your chances of success. Start your value investing journey today.